Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for ChartsAndMarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. Here we are. It's Friday, and we're together, and we've got some listeners out there.
Bob, as usual, we like to answer those listener questions, and our question today comes all the way from the Netherlands, where Willem Grooters asks, I notice that both gold and especially silver are on a tear. As a result, the gold-silver ratio is rising, but when I look at different markets, then I don't see a reason where and why investors are in a speculative move. For example, the yield curve, 30-year yield divided by the 5-year yield, remained flat in the last, say, 3 months. Does Mr. Hoye see a reason why the gold-silver ratio is rising? And does the peak momentum indicator give a clear signal? Thank you, Willem.
Well, very good, yeah. And let's make a note here, Jim, that he's talking about the silver-gold ratio. And, yeah, it is rising because when you're on a rally for gold and silver, typically silver will outperform. Actually, we used this very effectively back at the heady days of 2011 when gold and silver were going to the moon, and we used the silver-gold ratio and the weekly momentum RSI thing on it, and it got up to 90. Now, we knew from previous decades that when the silver-gold ratio became overbought, it was saying, hey, the play is maxed out, and anything above 80 to 85 was kind of marked the end of a play, but this one went up to 90. The only other time it had been at 90 was in January of 1980 on that fabulous blowout, and a multi-year bear market followed, which was the call we made in 2011. But anyways, it is there has been a rally in the precious metals recently with the renewed weakening in the U.S. dollar index. It got up to about 94 in March, and now it's down to 90 levels. So, yeah, this rally could go a little further. The U.S. dollar could sit at this level for a while yet, but on the precious metals, yeah, the rally can go a little further, but we wouldn't use it for a reason to buy the precious metal stocks. There's some probability that a financial crisis could be discovered in the fall, and with weakening general stock markets, the shares for gold and silver stocks would go down as well. So, not getting excited and buying this story.
Now, what's going on with the U.S. dollar, Bob?
Yeah, it got hit down into 89 in January, and at the time we noted that the dollar seasonally can set a low in sort of January, and this, I think it was the 1st of January, the low. It was oversold, quite oversold. So in noting that, we looked back at previous action in the U.S. dollar, as we call it, the DX, and it likes to do a hit and then spend about 4 months churning around building a base. So the way I wrote it up yesterday was that rally up to, I think it was 94 in early March was a little premature, and so it's come all the way back down to the 90 level, and working on that base. Now, what we also use is to determine when the base is completed, the DX has to rally above its own 20-week exponential moving average. And this is what we're waiting for now. We think the 4 months or so of base building is good, and especially as you've got fantastic speculation going on the other side in formerly commodities and stocks and sectors have been outstanding. So anyways, the rising above the 20-week moving average would complete the base in the U.S. dollar, and then a further extension would set the uptrend. And it's also worth noting that, for some years now, the U.S. dollar, like in 2008, as that bull market was completing, and also that was when crude oil got up to $147. So it built this kind of a base in 2008, and it moved. Oh, I can't remember the chart now, but it had a huge rally as the worst contraction since the 1930s hit global financial markets. So we're a similar pattern here, Jim. The U.S. dollar bottoming as financial speculation has gone to the moon. But we're looking at the pattern closely, and we'll advise when it completes. And the probability is that this after August, the U.S. dollar could take a rise as the huge speculation takes a hit. So oftentimes liquidity problems can be discovered in the fall. So yeah, it's the dollar index is fascinating. Also, this leads us to the story about inflation or deflation, and as far as I can tell, the Fed has been reckless for 100 years because it doesn't understand the financial markets. So, for example, you had that huge decade of inflation in tangible assets and commodities that ended in 1920. And in the U.S., that put the rate of CPI inflation up to, I think it was plus 24%, whereas in 1980, it was plus 15%, and everybody was going strange on it. And then the crash of commodities in 1921 took the U.S. rate of inflation to minus 16, if you can believe it. So the Federal Reserve was paralytic about deflation in the 1920s, and it decided that there wasn't enough inflation, so it was deliberately easy during a financial asset bubble. And that then contributed to the bubble. I mean, it would have happened anyways, because that's the way history works. So the Fed was easing dangerously during the 1920s, not understanding that once the inflation of financial assets is over, you get deflation in most everything. So here we are now for the last decade. Until this year, you've had a rise in commodities and you've had a rise in CPI inflation. But through the period, the Fed has been saying there's not enough inflation and has been remarkably easy during a raging mania in financial markets, just like the 1920s. So I'm staying with financial history that once this leg in the financial assets, like the stock market now, we had a springboard buy earlier in the week on the S&P. But once these final rallies are over in the stock market, and that's possible this summer, and then you get a possible contraction in the fall, the U.S. dollar will go up, and the stories about inflation will eventually disappear. But gosh, I've seen a guy, some kind of a hedge fund manager, I'll look up his name, a couple of months ago, was saying that it was going to be a return of the inflation, the hyperinflation that Germany experienced. It was called the Weimar inflation, because that was then a government called the Weimar Republic. And they really did take to the printing presses then. And you've seen images of people going along with wheelbarrows full of currency notes that were becoming worthless rather quickly. You can't have that in the United States. In financial markets in Germany, beginning with the First World War in 1914 through 1918, more or less went into hiding. It didn't have a strong credit market anyway. So then in 1922-23, when they turned on the printing presses, there was no credit market to destroy. Whereas in United States, it's the senior economy and the senior financial market, the senior currency, and the wreckage you would do to the bond market, of credit markets. There's no way that the U.S. can go printing like they did in the Weimar Republic. So, no, I think the pattern is working out nicely. This was the year that the stock market bubble could complete, and recently the action on the upside is creating all kinds of measurable technical excesses. So, yeah, I think the market will peak somewhere in the next couple of months and then roll over and get hit in the fall. And I think it'll go into probably a hit to all asset prices. That would be low-grade bonds, commodities. Oh, speaking of commodities, Jim, we had upside exhaustion signals on lumber, corn, soybeans, copper, where these things were going straight up. And even the work that I do using the weekly RSIs, you had the highest stuff since the strong commodity boom in 2008. So all the convictions about returning to a 1970s or a 19-teens inflation in commodities is in the market. And I take it as just firming commodities that you get with the last business cycle in a decade of bubbles, financial bubbles. So we can watch and see how it goes.
Bob, the Canadian dollar's at a 6-year high, around 83 cents US. Is that holiday going to last for long?
Gosh, it's nice to see a stronger dollar, and it's, of course, the commodity dollar story. And technically, during the week, we did get excesses on the Canadian dollar. Not as sharply excessive as, say, lumber or corn was, but no, it's now here's a chance to review some irony, Jim, is that of course, the Canadian and Australian are known as commodity currencies, but you have a federal government in Canada that's out to shut down all resource industry and the transportation of resources, particularly through pipelines and stuff like that. It's economically suicidal, but anyways, the federal government has these convictions about climate, and mainly they're convinced that they got to control everything, and at the moment they don't like pipelines. So it sets up this irony that the federal government is going to destroy the commodity industry in Canada, and therefore it won't be a commodity currency anymore. But I think that now that you've had the technical excess in the Canadian dollar, we can look for a significant correction beginning, say, maybe in July or something like that. So, yeah, it'll be interesting. With the federal government having little regard for parliamentary control, it's been on a bit of a authoritarian trip. So this would then be, you'd have two things to hit the Canadian dollar. One is fading commodity prices, and then the other, the realization of just what a constitutional and political mess Canada is in. So, now the outlook long-term for the Canadian dollar is not particularly good.
We'll have more with Bob Hoye right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, iron ore prices are ridiculous, according to one group that says fear is gripping the commodity market. Is that fear going to continue?
I think that was a couple of weeks, last week, the previous week's headline, and commodities that are not widely followed but are important economically, such as iron ore, and then some of the interesting metals, vanadium, cobalt, and whatnot, have been firm. And but I think it's just, as I said, with the business expansion that you get on the last leg of a financial mania. So, but I like the headline because it was so sensational and typical of the times. So, yep, a good headline to watch. This is what's happening here, Jim, is that you're getting the boom type headlines, and at the same time, I'm going to back up on that. You're getting the boom type headlines, which is the maturing event. At the same time, you're getting stories about problems, asset problems, or central bank problems, or bond problems, which is just the beginning of the next major story.
Warren warns that higher than 2007 house prices can be expected. Wow, that's when homes in the U.S. had their big crash. Canada didn't. Is Canada going to see a crash along with the U.S. this time around?
Yeah, I saw one yesterday that on an affordability index in North America, Toronto and even higher in Canada, residential homes are the least affordable in North America, maybe even compared to Europe too. So what happened in 2007 was a very good research time for us because we noted the change in the credit spreads for mortgage instruments that were changing and the mania, and then we compared it to the mania for residential real estate in the U.S. with the late 1920s boom, where Florida went absolutely crazy and then crashed. And then also the Jim Grant, who writes his Grant's investment interest rate letter, he's very good. He had done a marvelous study on the Excelsior Life building in Manhattan that was built with the bubble, and then just a bit before the 29 bubble completed, and then it fell into the long contraction whereby rents declined, vacancies were there, and then one entity after another went broke on it and wrote it off, and then mortgage on it were written off, and it took until the 1950s before that collapse in real estate worked itself out. I used the one of where the founding father of the Kennedy wealth, Joseph Kennedy, bought the Showmart building in Chicago, and it had been newly built, and he bought it maybe in the 1940s, too early, and then it took until the mid-50s before it finally got on side. So, yes, the real estate market is way overdone and due for a lengthy correction. Also, hey, I got what I remembered now, Jim, is that I found it decades ago in England. They had the big financial bubble that completed in 1873, and then that Great Depression ran until 1895. And then somebody had done a chart on farmland values in England. And just from memory, I haven't looked at it in ages, but I think the index was at 58 in 1873, and by 1895 was down to, say, something like 38, with not an uptick in 20 years. So, and that was for farmland value. And we're reading now that Bill Gates has been buying lots of farmland and stuff like that. So, no, I think we're heading for a typical post-bubble contraction where there'd be a lengthy period of pressure on prices.
Another headline that caught your attention: real estate investors undeterred by empty offices and hotel rooms.
That says it, doesn't it? They're buying the real estate already empty. Whereas if you bought the real estate towers, buildings, the Empire State Building, which was new in 1929, or as James Grant did with the Excelsior Life Building, you bought it, it was fully rented. And then you went into the problems. Now here, they're buying them when they're empty. And there's a major transition going on here, Jim, as we all know. This arbitrary shutdown because of the Wuhan flu has shown that many people and many businesses can operate remotely from home or at your vacation cottage or wherever, you know. I mean, and I think many people are going to kind of stay on the remote system. So that's without a financial contraction. Then when you add in the probability of a financial contraction, buying these real estate, or let's call them commercial real estate buildings, or hotels, could be a problem, getting any return out of it. So, no, it doesn't look good.
Perhaps, I was thinking with empty office space and there's always a shortage of farmland, why not turn these giant office towers into vertical farms?
You got a good one there, yeah. But what you'll find is that ultimately hard economics of cost and efficiencies will come in, and it'll be fascinating to watch. So.
Yes, and if people think there's going to be a rush back to the office, a survey I saw said a third of the people surveyed said they'd rather quit than go back to the office full time.
Boy, that's a strong statement, Jim. That is impressive. So that backs up my wandering around with intuition and my own circumstance that, well, here, I'll make a confession, Jim. I've been working at home alone for 40 years.
Well,
yeah, I left downtown House Street a long time ago, and you have to have then phone friends, and then now you have phone friends, and you have email friends, and internet, and chat spaces, and all this kind of stuff. So it's a whole lot easier now to be remote at home, but still connect with people than at any time in the past. So I think your numbers back that up, that there's a big transition here even before there's any serious threats in the financial markets. So, yeah.
And American businesses, don't forget, before the COVID recession, in the U.S., they had a labor shortage. And they were starting to beg for employees. Well, now that things are reopening, restaurants are finding people don't want to come back. They're blaming things like the stimulus checks that people received. But look, $1,600 doesn't last very long, and an extra $300 on your unemployment doesn't last long either. People in another survey, 60% said they were rethinking their careers during all that spare time they had at home.
Oh, yeah. In the States, they're calling them stimmies. Wolf, what's his name, calls them stimmies, the stimulus checks. And if there's an economic decision in there. If you're getting paid to stay at home and not work,
but also, do you want to work in a restaurant, or are you going to go and upgrade your education and do something else?
Now, also, here's another one. Back in the 70s and 80s in Canada, in any business cycle, the unemployment rates were higher than those in the States. And there was a study done, and the conclusion was that unemployed people in Canada get paid a whole lot more than unemployed people in the States. So there was always less unemployed in the States because, as I said, in Canada, it was much more economically beneficial to be unemployed. And so that was, of course, crazy. I think unemployment insurance schemes should be not run by the government, but run by private operations or even by unions. But when you get government involved in anything, even unemployment and stuff like that, it gets twisted and distorted, and it is always run to the political advantage of whichever politicians are involved in it. So
now in England, executives can buy what they call redundancy insurance, and I've had friends who got that. They were managers of major operations, and then for whatever reasons that operation was sold or shut down or went bankrupt, and they received their redundancy insurance payment, and it, saved their bacon until they found a new gig. And that's something that you don't have here for self-employed people, is redundancy insurance, and I think it could be a good move and maybe a sector that they might want to take a look at.
Oh, yeah, and then you also have casualty insurance as well. So, but it all should, as much as possible, should be privately and voluntarily run rather than run by governments and become mandates and authoritarian and all that sort of stuff. So, anyways, Jim, we're into some fascinating markets.
Well, I was just going to also mention, when it comes to unemployment insurance, back in the 90s when Paul Martin was the finance minister, the Canadian Unemployment Insurance Fund had a $53 billion surplus, whereas the Canadian pension plan was underfunded. And the Auditor General said, well, we only need about $13 billion in the Employment Insurance Fund. The rest is surplus. And I asked Paul Martin, the finance minister, sir, why don't you take the surplus in the unemployment fund and move it over to the pension fund? And he said, well, Jim, I can't. I can't do that. It's illegal. And I said, you're the finance minister. You could change the rules tomorrow. He just walked away. Whatever happened to that $53 billion surplus? I wonder.
Yeah, well,
Another headline that caught your eye, world's worst stock rout in Taiwan.
Yep, they got hit very hard with their indexes down. And the story is attributed to the same old problem, too much leverage, too much margin. And to keep that game going, prices have got to go up every day, so to speak. And once it breaks, then the last buyers in, highly leveraged, they got to either come up with margin or they get kicked out. So at the peak of a great financial stock bubble, people think that the central banks have the power to keep it going, but you always end up with a bear market and a contraction, and that's because when when the margin calls get going, Mr. Margin has much more power than Mr. Central Banker. So, and this is ahead of us.
Is
but
Taiwan...
It hit Taiwan, and it'll hit other lesser countries and exchanges as well. So I don't see it going away. It will continue to hit and disturb markets in different countries.
Is Taiwan the canary in the coal mine for us?
Possibly, yeah.
China's corporate bond agency has downgraded a number of bonds, and I think they've had a record number of bond failures. What's going on in China?
That's the next story. So these headlines that we've been reviewing have been the party headlines, which is the old story, the mature story, and the other is the little dreadful little things like margin calls and Taiwan getting hit and bond downgrades in China. This then will become the next big story. Yep.
And you have a nice little quote from Rome's Cicero about what happens in these little markets and why we should pay attention to them.
Oh, yeah. That magnificent thinker and writer, Cicero, 2,000 years ago in Rome, I can't quote his exact words, but I've used it from time to time. He did point out that if the eastern provinces, meaning the eastern end of the Mediterranean, Phoenicia and whatnot like that, had a financial problem in their financial markets, it would eventually hit Rome. And so this is, of course, what's happened ever since. You'll find that in the 1873 bubble, when it came down in London, they blamed the problem on speculative market in New York, which was then the very much lesser exchange. So then, this is how financial markets work. They get overdone, and then comes along Mr. Margin.
Bob, thank you so much for chatting with us.
Oh, Jim, always good to be with you, and look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, he'll be glad to answer them. You can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.